When I read that, I thought they were my sources, so I said investment return is the current dividend yield plus future earnings growth. And I estimated future earnings growth based on the earnings growth of the past 10 years. Very simple. Speculation is what market valuations do to that investment return, speculative return. And it does that. If PEs go way up, if they double over a decade, that will add 7% to the return. If they go down 50%, let's say they go from 20 to 40, 100%, that's 7% a year added to the investment return. That's what we got in the 80s and 90s, believe it or not. All that from just speculation. I'm a great one for playing with ideas to try and make them a little more interesting. And so I wanted something that paralleled the EMH, the efficient market hypothesis. And it didn't take hours to figure out. If you say cost matters hypothesis, you get CMH. And the one thing we know, everybody knows, academics, brokers, whatever it might be, investors, is the efficient market hypothesis is often right. But it is not always right. And you can, if you think the markets are highly efficient and they're not, you're going to pay a penalty for that. And that happens periodically along the roll of the markets. But the CMH always works. It is even Morningstar, with their sophisticated Morningstar Fund Statistical Service, the best one around. With all their sophisticated means of identifying star funds and so on, they say when it comes down to it, you would be better off picking funds on the basis of their cost than you would on the basis of our rating system. Now, that's a pretty good concession. The CMH has never quite caught on, and so I'm, of course, working on another one, which I'll sneak in here, my favorite subject. I am trying to get the industry and the press, the media, I guess I should say, to focus on the difference between ETFs and TIFs, another play on words, exchange-traded funds of all kinds of every way, shape, and form in traditional index funds based on the original Vanguard platform. Broad diversification, doesn't have to be the S&P 500. Total stock market is fine. Total international market is fine. Total bond market is fine. Very broad, very durable over time. You're not picking a segment of the market, you're picking the whole market. Very low cost, and the TIFs are much less volatile in their cash flows. ETF is like this. You never know what's going to happen. And in a given month, it can look like investors are fleeing the market, and it's just the spider had $20 billion of redemptions for the month. So the data ought to be active funds, traditional index funds, exchange-traded funds. But I can't sell it to anybody. I've been trying for years, and I'm not giving up.
Yeah, wonderful.
But it's a very different thing. And in this during the 2005 to 2009, the 2007 to 2009 period, there was not a single month in which TIFs had an outflow. Not a single month. In that period, the active funds were probably averaging negative, I don't know, 35 billion or something, and the exchange-traded funds actually had more in total, but they had one month where they took in $70 billion toward the market high, and another month toward the market low, when they redeemed $40 billion. In just those 2 months, the swing, $100 billion swing in cash flow between the high month and the low month, and the swing for the traditional index funds might have been $2 billion. So there's a difference in holdings, a difference in how you look at the market in the years ahead. This is a very different market, and it's a trading market, it's a speculative market, it's an entrepreneur's market. Entrepreneurs like those of the go-go era. They're in business to find a niche, as they say, in the marketplace that nobody has touched yet. Has nothing to do with it, good or not. It's an idea of what can we do to sell, and hardly a traditional index fund has started, I don't think, in the last 5 or 6 years. Well, everything is It's easy to get into the business. It's easy to make a big noise about how good your performance is. It's easy to claim smart beta, absolutely without any statistical backup at all. It doesn't do well. And no question, it has yet to outperform over 10 years, 7 years, 5 years, 3 years, and 1 year. The average smart beta fund has yet to outperform the S&P 500.
You know, for somebody who is so modest about his forecasting abilities, you actually have an amazing track record at making some incredible forecasts. I remember in 2007, you were asked what was going to happen to the Dow in 10 years. And if I'm not mistaken, you said something about Dow at 20,000 in 2017. And at the beginning of January of 2017, the Dow hit 20,000. So that was a pretty prescient and amazing forecast over a decade. How do you do it? What?
I'm tempted to say, "Oh shucks."
But
well,
you obviously had something in mind.
I mean, first, I don't like to do that.
Sure.
I don't know why I felt for doing it, but I don't do it without work. And so I used a little formula I developed, which I'll talk about more in a second, of where market returns come from, the source of market returns. That's what John Maynard Keynes says. Don't pay any attention to past returns unless you know their sources. And that I read in Princeton University in 1951, 1950, maybe 1949 even. It's certainly part of my research in the thesis, because that Keynes chapter on how the markets work is powerful. It's the best, I think it's the best chapter I could ever ask anybody to read to understand the markets. So I developed this sources of returns. He talked about investment and speculation there. So I talked about, those were the two sources of, he didn't quite call them that, but that's what they were. And when I read that, I thought they were my sources. So I said investment return is the current dividend yield plus future earnings growth. And I estimated future earnings growth based on the earnings growth of the past 10 years. Very simple. Speculation is what market valuations do to that investment return, speculative return. And it does that. If PEs go way up, if they double over a decade, that will add 7% to the return. If they go down 50%, let's say they go from 20 to 40, 100%, that's 7% a year added to the investment return. That's what we got in the 80s and 90s, believe it or not. All that from just speculation. And if they go down from a 20 to 10, that's also 7% backward. And so all you have to do is figure out where the PE will be 10 years later compared to the present. And what I have used is the PE. I used earnings growth for 10 years. I didn't do a lot of research on this. And PE for 30 years. And figured it would come back to the mean. So what happened in predicting the Dow? Well, the 10-year earnings growth was about 5%, 6%, I guess, in the previous 10 years. And the PE was then around 20, and I expected it to go down to about 22, I think. I expected it to go down to 17 or 18, and that cost a point of that return. So we had 7% minus 1 is 6%. And actually the number came out to be 5, so it must be 6% plus a point of speculative return negative to 5. And what happened? The market return was 5%. Actually, there was a little spread, not worth talking about, and it wasn't quite as accurate as I thought, but it was a funny little number, because that PE that I expected to go down, actually went up and gave a point to the market return. But the earnings growth was not 6, but 4. So we got 5 from both of them. So I tell people, and I talk about this in my book, not that particular example, after telling them how good my system has worked over 25 years, I say, hold the applause, because it can come from different sources.